you're losing a massive portion of your life energy to taxes. But the world elite play by a different set of rules. While the middle class argues over minor deductions and standard tax brackets, the ultra-wealthy utilize global frameworks to reduce their tax burden to absolute zero. Welcome to the reality of global tax strategy. The world has shifted. A decade ago, setting up international tax structures was reserved for billionaires and multinational corporations. Today, the internet has democratized access to these legal frameworks. Whether you're a digital nomad, a crypto investor, or an e-commerce entrepreneur, your laptop is your passport to financial sovereignty. This isn't about hiding money in suitcases or engaging in shady underground activities. Tax evasion is a crime, but tax avoidance is a legal right and a strategic imperative. In the next few minutes, we'll break down the precise frameworks modern investors and affluent individuals use to structure their global assets. We'll explore territorial tax systems, the specific loophole American citizens use to erase federal taxes, and how to shield borderless investments like decentralized finance and real estate trusts. By the time this video ends, you'll understand the blueprint of how wealth flows around the world without losing value to high-tax jurisdictions. Let's start with the foundation of location-independent wealth. What if the country you live in didn't care about the money you make somewhere else? Most countries, like the United Kingdom, Australia, or Canada, operate on a residential taxation model. They treat you like a permanent asset. If you spend more than 183 days within their borders, they claim the right to tax your worldwide income. They want a piece of your global pie, regardless of where that pie was baked. But a select group of countries uses something called a territorial tax system. This means they only tax income generated within their physical borders. Let's dive deeper into the mechanics of territorial tax systems. The beauty of this framework is its simplicity. In a worldwide taxation system, you must track deductions, write off business expenses, and hire expensive accountants just to reduce your burden by a few percentage points. In a territorial system, the math is binary. If the money comes from inside the border, you pay tax. If it comes from outside the border, you keep it. Imagine you're a remote consultant or a digital nomad making $200,000 a year from clients in Europe and North America. You decide to move your home base to a territorial tax country like Paraguay. Paraguay is often considered the gold standard for digital nomads because obtaining residency requires minimal friction. Because Paraguay operates on a territorial system, they look at your foreign income and tax it at 0%. You can enjoy a low cost of living, invest your capital, and keep every single penny you earn from outside the country. You don't need complex offshore bank accounts for this strategy to work. You just need to align your tax residency with a nation that respects foreign-sourced income. Costa Rica and Panama work the exact same way. Let's look at Costa Rica as a prime thought experiment. Under their modern digital nomad visa framework, remote workers can secure a temporary residency that affirms this tax exemption. You spend your mornings walking the beach and your afternoons taking video calls with foreign clients. The money hits your bank account, and the local tax authority demands nothing from you. You just need to ensure your economic center of interest, meaning your clients and your business contracts, remains outside the country. But what if you carry an American passport? If you hold American citizenship, you might think you're trapped because the United States is one of the only countries on Earth that taxes its citizens on worldwide income regardless of where they live. Fortunately, there is a legal escape hatch written into the tax code. It's called the Foreign Earned Income Exclusion. This is a federal tax rule that allows qualifying American taxpayers to exclude a large portion of their foreign earned income from their taxable income. Let's translate this into a real-world thought experiment. Imagine you move to Dubai to work as a remote software engineer for a tech company. For the tax year 2026, the maximum exclusion limit is $132,900 per person. To qualify, you must pass one of two tests. The first is the physical presence test, which means you need to be physically outside the United States for at least 330 full days during any period of 12 consecutive months. The second is the bona fide residence test, where you prove you have established a permanent home and integrated into the local society of a foreign country for an entire tax year. If you earn $130,000 in Dubai, you owe zero federal income tax on that money. The government wipes the slate clean. In addition to the income exclusion, the Internal Revenue Service also offers the foreign housing exclusion. This allows you to deduct certain housing expenses like rent and utilities, which further reduces your taxable income. If you're married and both spouses work abroad and meet the tests, you can combine this exclusion to shield over $250,000 from the Internal Revenue Service. Keep in mind, this exclusion applies only to earned income like a salary or consulting fees, not unearned income like stock market capital gains. Furthermore, the mechanics require careful planning. You must file IRS Form 2555 with your annual return, and you must maintain impeccable travel logs. A miscalculation of your travel days could void the exclusion and result in a devastating tax bill. Now, what happens when your income isn't tied to a traditional salary, but comes from complex, borderless investments? Modern investors generate wealth through assets that don't exist in a single physical location. Two prime examples are decentralized finance, known as DeFi, and real estate investment trusts, known as REITs. A REIT is a corporate entity that owns, operates, or finances income-producing real estate. It allows regular people to invest in large-scale properties, like shopping malls or apartment complexes, and collect dividends without ever dealing with tenants or mortgages. Decentralized finance involves using blockchain protocols to lend money, provide market liquidity, and earn high percentage yields without relying on a central banking authority. Why are these assets vulnerable? Because they generate passive income events around the clock. Imagine holding $500,000 in a DeFi lending protocol, generating an 8% annual yield, or owning vast shares in a REIT paying massive quarterly dividends. In a high-tax jurisdiction, the government will take a substantial chunk of your yield through capital gains taxes and dividend taxes. Every time a smart contract pays you interest, or a REIT issues a dividend, a taxable event is triggered in your home country. You lose a fraction of your wealth to the system, slowing down the velocity of your compounding interest. To fix this wealth leak, the elite utilize offshore corporate structures. They don't hold these assets as private individuals. They establish a limited liability company or an international business company in a zero-tax jurisdiction like the British Virgin Islands, the Cayman Islands, or the Bahamas. They transfer the legal ownership of their hardware digital wallets and their brokerage accounts, holding the REIT shares, to this offshore entity. Because the company is based in a jurisdiction with no corporate tax and no capital gains tax, the dividends and the crypto yields compound without interference. You defer the tax liability until you decide to pay yourself a salary or a dividend from that offshore company. If you combine this corporate structure with a personal move to a territorial tax country, you can receive those dividends free of local taxation. Making money is only half the battle. Keeping it safe from lawsuits, creditors, and estate taxes is the ultimate game. The wealthy understand that capital preservation requires a moat. When your net worth crosses into the millions, you become a visible target. One lawsuit can wipe out decades of hard work. The elite don't hold their biggest assets in their own names. Instead, they use an offshore trust. Let's talk about the anatomy of this defense system. A trust is a legal arrangement where you, the settlor, transfer ownership of your assets to a third party, known as the trustee. This trustee manages those assets for the beneficiaries, which can include your children or even yourself. In this triangle of power, the settlor gives up legal ownership, the trustee executes the rules of the trust deed, and the beneficiaries reap the rewards. Imagine you build a net worth of $5 million and a catastrophic lawsuit targets your business. If your wealth sits in a domestic bank account, a local judge can freeze your funds with one signature. Your life savings become inaccessible in a matter of hours. Now, imagine you place those assets into an offshore trust in the Cook Islands. The Cook Islands operates under the 1989 International Trust Act, a legal framework designed from the ground up to provide unparalleled asset protection. The local courts in the Cook Islands refuse to recognize foreign court judgments. If a creditor, An aggressive ex-business partner or a litigious client wants to seize your assets. They can't just bring a domestic court order to the island. They must travel across the world, hire local attorneys, and start a brand new trial under the local laws of the Cook Islands. Furthermore, the legal framework requires any challenger to prove beyond a reasonable doubt that you transferred assets with a specific intent to defraud that specific creditor, an almost impossible legal standard to meet. By removing legal ownership from your personal name, you separate yourself from liability while still benefiting from the wealth. This structure also bypasses standard probate and inheritance taxes, ensuring your wealth transfers to your next generation without government interference. None of these mechanics work in isolation. The true power of global wealth structuring happens when you stack these tools together to form a comprehensive fortress. The modern global wealth strategy is a combination of strategic residency, corporate structuring, and robust asset protection. You might live in Costa Rica to leverage their territorial tax system. You might hold an American passport, but use the Foreign Earned Income Exclusion to eliminate your tax obligation on active income. You hold your investment portfolio, including those real estate investment trusts and decentralized finance assets, inside an offshore holding company to ensure compound growth without taxation. And finally, you wrap the entire corporate structure inside a Cook Islands trust to create an impenetrable barrier against lawsuits and estate taxes. You own nothing on paper, but you control everything in practice. This is how legacy wealth is built, preserved, and passed down. Every single element we covered today requires careful planning, and a single mistake in your setup can trigger audits, penalties, or worse. The most common point of failure happens before you even set up an offshore company. It happens when you mismanage your physical presence and trigger a tax residency trap. Don't let a logistical error ruin your entire financial strategy. Avoid this six-figure tax mistake when working remotely.